an unlevered company?
So debt to equity ratio is 0?
Yes, there is no debt in the capital structure, then it is called as an unlevered company. What is a levered company? We have discussed this already, right? When we were discussing the hurdle rates, right? Unlevered company means, sorry, levered company means there is a debt, some debt in the capital structure, then it is called as a levered company. Okay, so we are going to extend our discussion regarding leverage in today's session. Okay, so let us take this example, very simple example to make you understand. The firm has the following EBIT, earnings before interest and taxes, under three different economic scenarios. The one is recession, moderate economic growth, and the economic boom. So these are the various cycles of the economy. Each one, if it happens, okay, what will be the EBIT? Okay, so if recession, if we feel that if the recession happens, or if the recession happens, then the EBIT will fall to $4 million. If there's a moderate growth, there is no recession as such, but there is a moderate growth, then $10 million will be your EBIT. Okay, economic boom, if it happens, $18 million will be your EBIT. Okay, because what is that you can understand out of here is, if economy is doing well, fairly well, then your earnings of the company will increase. That is what you can actually see from this, right? Next, let us see. So assume that the firm has 10 million shares outstanding. The company what we are discussing right now, this one, has got 10 million shares outstanding, which means there are 10 million shares which are issued. And there is no debt in its capital structure. Okay, there is no debt in the capital structure, and the company's tax rate is 40%. Okay, and there are two alternatives which are available. Okay, the first option is to the company what is available. It is an all equity option. That is, it will remain as an all equity financed firm, which means there is no debt in the capital structure, meaning that it's an unlevered firm. Okay. Second option is a levered firm, because there is a mix of financing which is happening. Okay, there is a invitation of debt into the capital structure. That is the reason we call it as a levered company. Okay, so it can borrow $50 million. Okay, so 10% is the million at 10%, which means 10% is the rate of interest if company goes for 50 million debt. Okay, buy back half of the outstanding shares. There are 10 million shares outstanding, and the company will buy back half of the shares outstanding through this particular buyback program. Okay, and reduces the number of shares outstanding to 5 million. So out of 10 million, 50% if you buy back half of it, so 5 million shares will be outstanding, and another 5 million will be debt will be there, which means you are actually converting an unlevered company into a levered company. 50% debt and 50% equity. Is it clear, everybody? Okay. So let us now compute the EPS in both of the scenarios. So what you guys can do is, you guys can actually open an Excel sheet. Along with me, you can work. Okay, it's a hands-on example to make you understand what is leverage. Okay, so I'm going to go with an Excel sheet. Hope Excel is visible. Okay, so the EBITs are given to us, right? Okay, there are three options which are available. The first one is recession, economic, moderate economic growth, right? So moderate growth, and the third option is boom, economic boom. Fine. And in both of them, in all of them, you've got two scenarios, right? So I'll just insert and I'll shift this EBIT here. So the first option is all equity. Second option is what? Second alternative is what? It is equity plus debt. Do you agree with me? This is what given in the question. How much is the EBIT of the company in recession? If company goes for recession, it is given that $400. Sorry, how much? 4 million, right? Okay, I have put 4 million yes. If it is recession also, it is going to be 4 million. That is, if it is a debt or equity, whatever the financing mix it is, it will not affect the EBITs normally. So it is only the financing mix it is. Okay, so moderate growth, if it happens, how much is the EBIT? How much was there? For moderate growth, 10 million. And it is economic growth, boom, it is 18 million. Just remember that 10 and 18. 10 million. Next is 18 million, right? Fine. So EBITs are fixed now. So less interest payment. If it is an all equity form, option 1, it is option 1, and this is option 2, right? For every financing, for every economic boom or recession or moderate growth, there are going to be 2 options, right? So first one is equity option, and the second one is the equity plus debt option. It is, right? It is something like this. The first option is all equity, and the second option is equity plus debt. That you should know. There are 2 options separately for each option. Okay. So how much is the interest we'll be paying in case of all equity option?
0.
Is 0. So I'm putting 0 here. For all the all equity options only, I'm putting 0. Supposing if company goes for a debt raising, how much interest supposedly it is supposed to pay? How much is the debt?
40%.
How much is the total? The debt, if company goes for a debt plus equity option?
10%.
10%.
Weighted average.
Weighted average of
It is a mixed financing. Company can borrow 50 million at the rate of 10%. 50 million, 10%, right? So 50 million I'll put here. Multiplied by 10%. Is it clear?
how it can be more than this. This was 4 million.
Okay, so 50 million at the rate of 10%.
Okay.
You can see here 50 million at the rate of 10%, right?
EBITDA was just 4 million.
Okay, so
We are-
yes, EBITDA is known to us 4, 10, and 18 in case of recession, moderate growth, and economic growth. Okay. So whatever is the level of debt and equity does not matter. Whatever is the EBIT, it is going to be the interest payment the company has to pay. Hope until this everybody are clear. Any doubts are there, you can ask. So if you deduct interest out of this, what you will get is earnings before taxes, right? How much is earnings before taxes? EBIT minus interest. This minus this is going to be EBT, earnings before taxes. So after this, less taxes at the rate of 40%.
Sir, 1 second. How much is this? Interest is 10% of the 50 million, right?
That's right.
So there is one more zero, I believe. 40 million was the EBITDA. So 10% should be 5 lakh. Okay, okay.
That
It
was
was
4 million.
EBITDA is
not
4
1.
million.
okay, okay, okay. Understood. Thank you, thank you.
Is it clear?
Yes, yes, yes.
Okay, so how much is the tax? Can you compute tax on this EBT multiplied by 40%? Right? So here I am not putting any taxes because you will not be paying any taxes here because we are already lost here. Fine. Clear? So earnings after taxes will be how much? This minus this. EBT minus taxes will be your earnings after taxes. So after this, can you tell me how many number of shares are there? Post S stands for outstanding. How many equity shares outstanding? Let us go back.
Same in the first case.
10 million, right?
Yes.
10 million in the first case. And 5 million will be 50% will be reduced. 5 million in the next case, so second option, right? 10 and 5 million. So I'll write 10 million here. And I'll copy for all equity 10 million. And for all the mixed financing, that is equity plus debt financing, I'll put 5 million. So now can you compute EPS, earnings per share? Earnings per share is equal to
Why you are considering zero in case of equity and
EAT
equity
divided by this
investing
number
option
of
C?
shares.
why are we putting 0 here, right?
Yes,
This one.
yes, sir. Yes, sir.
Tell me why. Think and tell me. There is a loss here, right? Minus 1 million it is. On 1 million losses, you're paying any taxes.
Yes,
You'll not be paying, right? So that is the reason I'm putting 0 here. Is it clear?
yes, sir.
So tell me how much is EPS, how to compute this EPS?
EAT divided by number of shares.
Yeah, so that is profits divided by number of shares outstanding, right? So if I do, I'm getting 0.24 in this case. How much are you getting? Same? Is it matching with your answers?
Yes.
Okay, great. Okay. So by this, what is the learning for you? We have done some calculation here. Tell me what is the learning for you from this example? That's it.
During the economic boom,
Okay.
better
During the economic boom?
yes, EPS is better in case of this.
Yeah, EPS is
Next slide.
going up like anything.
Yes.
Okay, in case of economic boom. And also we can observe that within the economic boom scenario, all equity is giving you 1.08 as an EPS. And equity plus debt is giving 1.56, which is more than 0.108. Why is that so? Why it is more?
Tax has reduced.
Tax has reduced. In
Oh.
fact,
By
Less than tax.
by
Payment of tax.
why tax has reduced here? You are correct. Why tax has reduced?
Because the debt component is there. So for the debt component, we need not pay tax.
Correct. This is actually called as tax advantage. Supposing that if you're not borrowing this, you would have paid income tax of how much? Income tax of almost 7 lakh, how much? 7.2 million it is.
7.2 million.
Is it not? So we are paying only 5.2 million because of the tax advantage. Understood now what is tax advantage? That is what I was stressing. Okay. So the moment you become a levered company, because of the tax advantage, your EPS goes up. In other words, in good times, it is very good. In bad times, it is very bad. So can we say that leverage is a double-edged sword?
Yes, sir.
Yes.
Okay? In good times, it is very good. In bad times, it is very bad. So because of this, we call leverage as a double-edged sword. It makes good also, it makes bad also. Okay, if you expect that the company is really going to perform well, what you can do now at that point in time? If you
Lever
know
the
that the
company.
company is
Take
going to
loan.
perform well, you
Take
can think
debts.
of going for an debt.
Take that.
When you feel that you are not going to do well, what you have to do? You have to cut down on the debt.
Repay the loan.
In other words, what I'm trying to say is, if you are going to borrow the money means, it shows that your company's guts to make profits to make it happen. Otherwise, your company would have actually not gone for going for debt. Okay, so if everything else is good only, your company should go out and go for debt. Otherwise, company should never go for debt, because it goes. You know that what happens if you borrow debt? It adds up to the agency costs. It also adds up to the bankruptcy costs. Chance of going probability of going bankrupt will also increase the moment you increase your borrowings. Okay, so because this is actually going to be called as leverage, you're taking advantage. What is leverage? You're taking advantage of debt and you're enhancing the return to the shareholders. Otherwise, your returns to the shareholders would have been 1.08 only. Okay, since you're taking debt, you're actually enhancing the return of the shareholders. Understanding this? Don't you feel that you're enhancing the return to the equity shareholders by taking leverage, by taking debt into the capital structure? Okay, you're taking advantage of leverage. You're taking advantage of debt into the capital structure. That is why it is actually called as what? Leverage. Is it clear, everybody, why it is called as leverage? Anything
Yes.
else you would like to know now out of this example? Any other observations?
Sir, in this, like, if we look earning wise, so we are well off without debt
Without
in
debt,
any
it is
case,
well off.
in any scenario.
In any scenario, is it so? Think
EAT in any scenario
Like,
will be higher.
earning wise, if we look, our focus is main on earning for the company in that sense.
Earnings per share is important, right? Because as a shareholder, I am interested in my earnings.
Yeah, but for company, they might be interested in earning profit.
Earning profit is also the important. I'm not saying no to it. So ultimately,
But,
you could actually focus on EPS.
But number of shares are more in that higher EAT. Yes. Earning per share will be less.
Yes, yes. So the number of shares are higher. Okay. And that is the reason we actually bought out those company shares, and that's how we have increased the EPS, right? Think about it. Yes, Abhishek, please.
So I think just adding to what Dipesh is saying, I believe even in finance, all these books begin with two theories about profit maximization versus shareholder wealth maximization.
Correct.
So given, let's say, any of us lead any large cap companies in the future, they would may be concerned with leveraging the company in good times. But given any of us still continues to lead a small business, in that case, profit maximization is more important, and he has to. I mean, in either ways, can we say that both perspectives are correct given what boat we are sailing, what size boat we're sailing?
That perspective also I would like to welcome. But at the same time, you have to see that you're actually enhancing the returns to the equity shareholders. That is not going to happen if you are not going to borrow the money. In good times, it is good, and bad times, it is really bad. That is why I told you it is. Okay, what you are trying to say is also it is correct, but at the same time, if you want to enhance your own return, supposing that you're an grocery shop owner. Okay, if you actually borrow money, okay, you can actually show that as your deductible, right? Your business expense. So because of which, what happens is you can actually show less profits and you pay less to the government.
Right.
Forget about the number of shares. What is it? It's only for the examples that we have taken number of shares here. Otherwise, also you're saving something, right? Okay. So with this, let me go back where we left off. So what is this leverage then? What I discussed with an example. I am going to explain you with an figure now. That is the academicians, like what we do is we explain the same with case, we explain the same with the PPT, we also explain the same with some handout. So consider this as a handout now. Okay. So you want to lift this big rock. How are you going to lift this big rock? Lifting a big rock will be difficult. What is big rock for us is enhancing the return to the equity shareholders is a big rock it is. How are you going to enhance the return to the equity shareholders? By taking a small debt into the capital structure. When you take a small debt into the capital structure, okay, it acts as a lever, and because of which you can easily lift this big rock. Otherwise, lifting big rock, still you can lift this big rock, but the substantial efforts is required. Since you have taken debt into the capital structure, this acts as a fulcrum now. What is fulcrum? This small stone, what is it you are keeping to lift this particular big stone? Okay, so this is all about the concept of leverage. Is it clear what is the concept of leverage? You are enhancing the return to the equity shareholders by taking small debt into the capital structure. Or debt into the capital structure, then it is actually going to be called as what? Supposing that if this particular debt becomes very huge, can you enhance return to the shareholders? Can you lift this big rock if there is one more big rock?
No.
Difficult it is it not? So you'll understand that is the reason you should not be going 90%, 100% of debt equity ratio. Okay. So let us go see what is the usefulness of this leverage. Leverage states that the debt brings both potential profits and the potential losses for the equity investors because it is a double-edged sword it is. Second, it provides a measure of the break-even between two strategies. Which one do you choose? All equity or mixed? Okay, so mixed is always good. Okay, so for some companies, if they feel it is not going all equity is better for them because they can actually avoid the bankruptcy cost and all other costs which are associated with it. Okay, so because of this, they might have not gone as a company's decision. They must have not gone for equity, sorry, debt as such. Okay, if management is convinced that it can earn more than the break-even operating income, the analysis will tilt the scale in favor of the strategy with the greater leverage. Okay, but if you really go, if you come to PGP, if you take admission into PGP, leverage concept we'll discuss for about 3 hours, three to 4 hours with the various examples, numerical examples and numerical cases, all that. But ultimately the crux is this only it is. You are actually enhancing the return to the equity shareholders by taking some debt into the capital structure. If you understand this, that's it. That's it about leverage is all about. Okay, so
Just a quick question.
yeah,
Maybe it is related to personal finance.
yeah,
Some
good.
people nowadays do investment looking at the debt to equity ratio.
Okay.
So in that case, a company which are having debt to equity ratio close to zero.
Yeah.
In long term, are they not that good idea of investment?
Yeah, Naresh, since you have raised this, if you ask me my investment preference, supposing that I want to evaluate any company, supposing that if it is not an, let's say, banking and financial company, it is manufacturing, purely manufacturing company. Okay, I prefer as an investor less than 0.5 debt to equity ratio. I, as an investor, I feel it is actually good to go with a company which has got less exposure to debt. I don't want to go for a debt which has got more exposure to debt. Okay, because I know that as an investor, in good times, it is really good for the company. Bad time, it is actually going to be very bad for the company. So I want to be stable. My money should be saved off. Okay, whatever the economic scenario it is. So because of that, as an investor, I'm taking extra caution not to invest in a company which has got a debt to equity ratio more than 0.5. This is my personal preference. And you're right too. Okay.
But having zero debt to equity ratio is also.
That is the reason I'm saying less debt is good. Exactly zero means there is no leverage, which means you are not actually taking advantage of debt. Are you understanding what I'm saying?
Yes.
Yes. So that is the reason I said 0.5 and lesser than that, I'm okay with it. Okay. Even if it is zero debt also, it is fine with me. For personally, if you ask me, zero debt also fine with me. Because a company has got flexibility to raise financing in the next in the years to come. Okay. So next is let us go to Boeing case. The case has been posted
Sir,
on.
a quick question, sir.
Please.
So typically, when we are discussing this about large public companies, right?
Yes.
So are the logic similar for something like a VC funded company or a private equity funded company? Are the logic similar?
Interesting, because in case of VC and private equity firms, you should always go with the zero debt. Tell me why.
Because there's no leverage to be taken, or
Not because there is no leverage, because I have actually willingly I don't want to go for a debt. Why? If I'm the stage of, let's say, angel investing, or maybe what is it, venture capitalist, or maybe a private equity funding, okay, I should ideally not be going for a debt financing at all. Why?
So maybe one reason is because already I have investors' confidence and I could really move forward to Series B, get forward ahead with equity itself.
Yeah, any other answers? Why I should not be looking for a debt if I am a company funded with VC or maybe equity, private equity for that matter?
Risk will be less, and moreover, if there is, as you said, if there is in bad situations, it could be, will not get the money back. So it's difficult.
No, supposing that if you are a company, if you are there in that level, you are a private company and you are now looking for a venture capital funding, which means there is no break even which has happened in your company. You are not in a position to pay the interest. What if your product fails tomorrow? Are you able to pay the money back to the debt holders, which is being guaranteed for them? You are a high growth company, young and high growth company. Something like Flipkart, something like Zomato, something like Nykaa, can they offer to take a debt into the capital structure?
no?
Because they are the cash burning companies. Tell me, what do you understand by cash burning companies?
They're still growing and they're not mature enough to create net cash flows.
Whatever the money they're
Net
investing,
income is negative
they're
year on
negative,
year.
yes, their profits are actually negative. They are not still break even. Okay, they are actually now building confidence among the public. Okay, so they never offer to actually take up a debt capital at all. If they take debt capital, end of their business. Mark my words, it is end of their business actually. Okay, so only listed firms and who has got actually, let's say, a large amount of backings, and who has got financial strength, muscle, okay, then only they can actually offer to go for raising debt capital. That has been evident from the leverage example, what we have taken just now. Right? Is it clear? Yeah. So let us go to the Boeing case now. I'll share any other doubts before I move on to that. Okay. So let me actually go to the Boeing. It is there listed. It is there on the LMS. Hope the LMS is visible to you.
Yes, sir.
You can see the finance decision case plus problem set. Can you download this?
Yes.
Okay, please download it and keep it ready. I have mine is ready today. Once you have downloaded this, okay, so you can just put it in the chat box, yes, so that I can start. Around a week ago, I must have uploaded this, but I have made some modification. Again, today afternoon, I must have actually uploaded one more file of this updated, altered one. So can you please download that one?
Sir, during the class, I think in last class, some modification we have done.
This modification I did today afternoon.
No, I'm saying in the previous class, some modification we have done in the presentation. So
Want me to
that
upload
the presentation. Yes.
You want me to
I'm saying in the previous class, we have done some modification in the presentation. So that modified presentation have you uploaded over the
I normally must have done it.
What is the name of this place?
So for this class, you should hit on this session 12-13 financial decision plus problems. And the previous class presentation, investment decision, I must have already done this. I think so. I must have uploaded, but I forgot. You can only what I can do is whatever the file I have, I can withdraw this. I delete this and I can upload it after the class. Is it fine?
Okay, okay.
That can be done, I think. For that will remove all the confusion. Okay, it's fine. So analyzing capital structure of Boeing Limited. So this is a sort of an case. It is. Let us go through this. Okay. So simultaneously, what you have to do is you open an Excel sheet also. So half of your screen should be my class should be visible. Half of the class should be your Excel should be visible to yourself. Okay. So that way you can actually split your screen into two, the way you used to do it earlier classes as well. So I'm just renaming this. I'll be adding one more sheet here. Hope Excel is visible to everybody.
Yes, sir.
Yes.
Okay. So let me start this. I'll keep reading and whatever I feel like writing, I'll write it in the, what is given, I'll go write it in the Excel sheet. Okay. The cost of capital approach can be used to find the optimal capital structure for Boeing. First of all, you have to understand what is optimal capital structure. The capital structure which minimizes the hurdle rate, which minimizes the cost of capital, is termed as what? The optimal capital structure. In other words, you tell me how much, at what point of debt, what do you mean by what point of debt, whether it is 20%, 25%, 30, 35, 40, what percentage of debt in the capital structure we can afford to borrow, and that makes my cost of capital lowest of the all. Okay, so that is termed as what? Optimal capital structure. Fine. So let us go through this. Okay, the cost of capital approach. There are various approaches. Okay, for doing this optimal capital structure. One of such methods is the cost of capital approach. It is. Okay, so cost of capital approach is actually going to be called, is normally called as practically tenable. Practically, the practitioners take up this particular approach, and that is the reason I am also going to discuss in the class the cost of capital approach. And I have seen various Ivy and the Harvard cases. So none of the cases explained properly regarding the cost of capital approach. So that is the reason I myself thought of writing a case on this particular approach. Okay, so soon I am publishing a case also. I am off the way already. Okay, so the cost of capital approach we are discussing now. So Boeing had 6,972 million in debt on its book. What is the meaning of this? Is company has got this much of, this is what is the book value of debt it is. What we require is market value. Book value is useless for us, right? So with an estimated market value inclusive of operating leases of 8,194 million it is. So it is including the leases, because leases are also part of your now leases are actually going to be part of your, we should also treat it is a debt it is. Why leases are debt? Because it is sharing the properties of a debt capital. That is the reason we are actually adding leases also. If you really see, I told you, we have to bifurcate if any instrument is there. If it is a hybrid instrument, we have to actually convert that into, we have to bifurcate into equity and debt, and then we have to be solving the problem. So in this particular case, what they did is they actually gave us the market value of debt and leases nicely divided and given to us. That is the reason we are actually taking 8,194 as our market value debt it is. So I am going here.
Sir, sorry to interrupt. Why there is a market value of debt?
Market value of debt is given for information only. It is. You can choose to ignore. Is it fine?
Yes, sir.
Or to confuse you, in other words. Okay. Normally, we should take market value only, as we discussed in the session as well. So it is 8,194 million. It is. I'm copying this. I'm just calling it as debt. So I will write it as in detail market value. Fine. So the market value of equity at the same time was 32,595 million. So I am copying this as well now. Market value of equity is 32,595. The market price per share is $32.25. Market price per share is equal to 32 point. How much is that? $32.25. And
Yes, sir.
and there were 1,010.7 million shares outstanding. So number of shares outstanding. So let me just cross multiply and see whether it is matching with the answer. So both it is matching. This and this is matching. Why it should match? You know the reason. If you have forgotten, then I am not responsible. Clear? It is matching, right?
Yes, sir, it is matching.
Okay. So let me go towards the next part of the problem. Proportionately, 20.09% of the overall financing mix was debt and remaining 79.91% was equity. In other words, they are saying what is the debt ratio and equity ratio. So let us confirm whether it is correct or not. Can you write it as debt ratio? How to compute debt ratio?
Debt versus total.
Debt by debt plus equity.
Debt divided by debt plus
Equity.
equity, right? Just see, is it matching with the one, what is that they have given? In other words, we are also discussing like how to actually compute it, though it is given in the problem, but we are doing it. How much should be equity ratio? 1 minus this. Correct? Matching? 79.91 is matching.
Yes.
And 20.1, 20.09 it is matching. So it is matching with the figures what they have given us. In other words, we are also learning how to compute. Okay, cross verifying, and we are also learning and moving forward. Fine. Next, the beta for Boeing stock is 1.0. What is the beta? 1 point. It is not that aggressive. It is in line with the index. It is moving. It is nor aggressive nor defensive. It is correct. This is what is my first observation. Can you tell me whether it is levered or unlevered beta?
Levered.
Levered, they have debt
They have that
portion.
of ratio.
It is a levered beta. Very good. So now we are following corporate finance. It's a levered beta. It's because there is a debt in the capital structure, and the beta we watch, what is it you have computed? Obviously, it should have been a levered beta. It is. Okay. Let me go further. What is given? The treasury bond rate at the time was 5%. Treasury bond rate, how much? What is this 5%? Where this information will be useful?
So comparing the WACC.
WACC.
Comparing the WACC and
Cost of capital.
Interest.
Is also risk-free rate for computation of cost of equity. Correct. So next is what they have given. Using an estimated market risk premium of 5.5%. This is ERP. What is ERP given? 5.5%. What is ERP? ERP is equal to not enterprise resource planning, but we discussed something different. What is it? ERP is also called as return of the market minus RF. Return of the market over and above risk-free rate is called as ERP. That's it. Okay. So estimated cost of equity for Boeing is 10.58. Okay. So they are saying that cost of equity is 10.8. Cost of equity, let us compute because we have got all the components with us. Cost of equity is equal to what? RFR plus beta times ERP. So we have got all the ingredients. So RFR multiplied by beta times risk premium. Is the math? His answer is matching with the one given in the. This is cost of equity. We just now computed. How many of you are doing along with me until this? Two participants raise their hands. 3, 5, 7, 8, 10, 11, okay, 12, 13, 15. Okay, fine. Say, fine. Now let us go forward. Cost of equity is 10.56. We got it. Okay, ignore this 10.58. I think it must have been a mistake. Here you can see cost of equity is equal to RFR plus beta times market risk premium. 10.56 they have given here. Okay, so this is the one which we have got the answer, right? It is matching. So Boeing senior debt was rated AA. What do you mean by senior debt? In the debt also there are going to be seniority, senior debt, junior debt. The debt which is taken first is called as a senior debt. That's it. Right? So Boeing senior debt was rated AA. Based on this rating, pre-tax cost of debt of Boeing is 5.5%. So I'm writing here Boeing's debt. So I'm writing it as AA rating. And the pre-tax cost of debt is 5.5%. Pre-tax cost of debt for Boeing is 5.5%. That is given in the problem. The tax rate applicable for Boeing is 35%. They have given here. Tax rate applicable for Boeing is 35%. So can you compute now post-tax cost of debt? How to compute this? Anybody?
Multiply by 1.35.
Multiply by 1 minus 3.35, right?
Yes, yes.
Yes,
1 minus.
35%. Yeah.
So we got the answer here, you can see. I am getting 3.58%. Are you also getting the same? Okay, fine. So let us move forward.
So please show that post-tax cost of, okay. Just 1 minute.
Sure. Yes, Varun, do you have any question to ask?
It's 3.5.
Okay, sir.
So 3.58. So that is after tax cost of debt is also matching. Okay. So value of the firm is how much? It is given in the problem.
Sum of both.
Value of the firm is
4789.
you have to add both of them. That is 8,194 plus 32,595. We get the value of the firm. Yeah. So after tax cost of debt is matching. So WACC has been computed using the market value. So WACC, how to compute, you know it. What is WACC also, you know it. So compute and get 9.15. Let us see whether we get 9.15. So computation of WACC. We are just following what is been given in the problem. What is our ultimate aim? Our ultimate aim is we have to compute optimal capital structure, which means we should be able to tell how much is the percentage of debt and equity is suitable for this company, Boeing. Computation of WACC, how much is the WACC? So WACC is equal to what? The formula is already given there. WACC is equal to cost of equity multiplied by weight of equity. I'm just writing it here. WACC is equal to how much? How to compute this is equal to cost of equity multiplied by cost of equity we just now computed multiplied by weight of equity, also we know it, plus cost of debt, that is post tax cost of debt, not pre-tax, always it is post tax, multiplied by 20.09. Are we getting?
Please show again.
Sure. Cost of equity multiplied by market value weight of the equity interest. Cross multiply both.
B70. Is this?
No, my may be different, right?
No, it was not this. Okay, cost of equity. Okay, okay.
Is it fine? Everybody getting 9.5? Yes, Preeti madam.
Yes, sir. Oh, yeah, 9.15.
Getting them? Oh, okay. Great. So understood, no? So we are actually a sort of revision is happening here now. Because it's a cost of capital approach, so we have to compute the WACC. So why have we computed cost of equity, cost of debt? Everything is now clear to you because we have to compute the WACC. Okay. Next is, what are we supposed to compute as per this handout? Boeing cost of equity and leverage we have to be computing. So I just copy this. I paste it here. So Boeing's lever beta is how much? As we already know.
1.0.
So I just go and click it. Can you compute Boeing's unlevered beta? Of course, it is given in the problem as a 0.8987, but we should compute it. How to compute unlevered beta? It is current beta divided by how to compute unlevered beta? Unlevered beta is equal to current beta divided by 1 plus 1 minus tax rate is how much? 35%. multiplied by debt by equity. Multiplied by debt by equity. So debt is here. Equity is also here. So I am getting 0.868, matching with the answer given in the problem.
Take a level.
Is it matching?
Yes, sir.
If you have done 0.87, just put it in the chat box as yes. Let's see how many of you have done. Okay. Dinesh sir, Soham. So we are done with the unlevered beta.
Yes, sir.
So can you now compute this one? Leverage beta, cost of equity. Next line. Okay. So for this, there's a ready table given to us. Let us make use of that table. Beta and cost of equity. So what is the debt ratio here? 0 to 90. What is the beta at 0% debt ratio? Tell me.
Unlevered beta.
That's it, right? You know it. Can you tell me when the beta is 10%, when debt is 10%, how much is beta?
Sir, 10 into levered beta.
Is it so?
We have to change that formula for debt to ratio.
Which means we want a levered form, right? We have to make use of this formula again. Can you use this formula and get? Because we are computing levered beta. Please try to understand. We are computing levered betas. At 10%, how to do it is equal to beta unlevered multiplied by 1 plus 1 minus tax rate closed multiplied by debt by equity. Can you do 10% divided by 10 plus 1 minus 10%. Can you do this as an easy method? Otherwise, you have to do this for all the rows if you don't do this way. Are you understanding what I just now did?
So could you repeat it once more, please?
I am just following this formula. Levered beta. Here it is there. No? What is levered beta? Beta unlevered. This 0.87 is unlevered beta because debt at 0. So multiplied by, that is B41. In my case, 0.87 is B41. It is multiplied by 1 plus 1 minus tax rate. Tax rate is 35%. This C21 in my case. Close the brackets, multiplied by debt by equity. Debt is 10%. I clicked A42. In my case, it is A42. But divided by equity. What is equity form is 10 plus 1 minus 10. Correct, no?
Understood, sir, understood. So
Understood?
this is total equity, no? 10 plus the rest of it.
Correct. Are you understanding the logic of 1 minus A42? 1 minus 10% means 90% is debt, equity it is, in other words. Instead of writing 90%, I am writing it as 1 minus 10%. Why? Because if I click enter, okay, so here I can double click and I can easily get all the betas in just in one click. That is the reason. Are you getting the same answers like mine?
Yes.
Dinesh sir?
Can you just show the formula again?
Or I may be wrong also. Please
Sir,
don't.
one question, sir. In the denominator, why are we adding up A42? It is debt by equity. So debt is A42.
No, A debt plus equity means 10% is A42. Please try to understand. 1 minus A42 means it is 90%.
Yeah, 90% is the equity and 10% is the debt.
That is the reason we are adding both. Na? Okay, if it is causing confusion for you, I can straight away write it as 100%. Is it solves your purpose?
My question, should it be 100% or 90%?
Debt by equity.
So in unlevered beta, we have done debt by equity. We only considered equity. We didn't add debt and equity as a total. And we're calculating the unlevered beta.
If you do that way also, you'll get the right answer. What I'm trying to say is, just a minute. I know what you're saying is, we computed while doing that, this divided by this. Correct?
Right, sir.
Yes, sir.
So now what we are doing is, this divided by this only we are doing. You can just see the effect will be same only. You can just compute and see it will be same only.
I mean, now you're doing debt by total asset, debt plus equity.
You see na difference. I'll do the method which I did earlier. Now, okay. So if I'm getting different answer, then I should not be doing it. Wait. So, and beta unlevered is how much? I'm doing once again using the way I did it. Multiplied by 1 plus 1 minus 35% multiplied by debt by equity. So we don't know whether it is 10% or not. How much it is? Is it not?
Brackets. If you put bracket on B4 by B5.
Let me see.
No, you have to consider 10%.
It's 10 by 90, sir.
Correct. So 0.925 it is.
Sir, in your old formula, you have used debt by debt plus equity, whereas that is why that 100% is there. Now you're using debt by equity, so 10% by 90%. That is the only difference.
Yeah, we are assuming that it is in 10% approximately. Okay, that is the reason it is giving me a different answer. Okay.
So there is one more thing. While you are calculating for the 20%, you are always using the beta unlevered. We need to use the beta unlevered. That is 0.87. Otherwise, whatever the beta we are calculating are the levered beta.
You're right. So which means
So
what you're trying to say, this should be fixed.
Yes, it should be fixed.
Now you see?
Now it's no, just recalculate again. Yeah, no, it's matching.
It is matching, right? You're right, because your logic is correct. Otherwise, what is the use of using this? Is it matching now? Yeah, anybody has got any
dividing by
doubts?
divided by 100% is not correct.
That is, sir, the only question remaining is, as per this formula, we are supposed to say beta unlevered, that is fixed, into 1 plus 1 minus tax rate into debt by equity. So with 10% debt, equity should be 90%. So the formula should be 10% divided by 90%, or in that way. So is that formula?
Right. So what you're trying to say is, I'll just delete all of this. Okay, so this is fixing, correct?
Yes, sir.
Multiplied by 1 plus 1 minus 35%.
Yes.
Multiplied by
debt is 10%.
Debt is 10%. Divided by
1 minus 10%.
1 minus 10%. This is correct for everybody?
Yes.
Yes, sir.
Yes, sir. Yes, sir. Now it is correct.
Hopefully it is correct now.
Yes, sir.
Yes, sir.
Hope you have not made any mistake now. Okay. So can you now compute cost of equity at each debt ratio? Cost of equity is, you know what is cost of equity? It is RFR. This is RFR plus beta. This should be fixed. RFR should be fixed, right? This is constant. Plus beta should be variable. Multiplied by equity risk premium should be fixed. ERP should be fixed. Just see. Yeah, Deepesh answer is right. So I'm also getting, okay.
So can you click on cost of equity?
Yeah, cost of equity is simple. It is, this is RFR plus beta times risk premium, ERP. Yes, so Naresh's answer is matching with my answer for cost of equity. Yeah, Deepesh also getting. Sachin done. Okay. Clear, everybody? So cost of equity, what is the observation? What you can make here is, can you read this particular table now? What you can understand out of this?
As debt ratio increases, cost of equity also increases.
If you borrow more money, equity investors will be asking more return, in other words, because your beta is also actually going to be risky, means growing. That is the reason your cost of equity is also growing, because that is the only variable which is actually going up. Getting it what I'm saying?
So it is getting riskier then.
Yes. So as and when your debt ratio goes up, your company's riskiness also grows, and because of which your equity investors ask for more return.
So it will become that company where you will not invest.
I'm not saying that I should not invest.
I mean,
because
higher the risk, so safe players need not invest in such companies, right? Where beta is very high, levered beta.
Yes. So that is the reason I told you personally as well. If you ask me, there are two companies, high debt to equity ratio and low debt to equity ratio. Everything else remaining the same. I choose less debt to equity ratio. That is what I told you. When Mahesh was actually asking me. Right? This is one of the reasons.
What is the ideal range of levered beta?
What is the ideal?
range of levered. Good company.
There is nothing called as idea. We can only tell once we come out with the hurdle rate which it minimizes. Okay, we have to go with that mix of debt and equity where your hurdle rate is least. Right? That is why we are doing all of this experiment. What is it? So after this, let us go to the next item in the. So we are done with this table. Now let us go to the Boeing's cost of debt and leverage. Right? So Boeing's cost of debt and leverage. So Boeing's cost of debt and leverage, interest coverage ratio it is. I'll pick up this interest coverage ratio. So can you tell me how much is EBIT and interest expense for this company? So there is a data given to us. Just search, where is it? It is here, right? EBIT is 1720. It is given here, you can see. EBIT is 1720. Visible?
This is in millions, maybe.
$1720 million it is. So I am writing it as EBIT is 1720. So divided by how much is the interest expense?
450.
Expense is 453. Given in the problem here. 453. So how much is the interest coverage ratio we get is this much. Interest coverage ratio is, in short, I am writing it as IC ratio. How much is IC ratio? It is 3.80.
So what is significance of IC ratio?
Higher the better it is. The rating companies will look at this ratio and they are going to rate the company. Okay, they also take into consideration of various other aspects. Okay, but significant ratio is IC ratio. Don't forget this ratio. In any company, if you're investing, you have got two companies. You should go with the company where the IC ratio is higher. What do you mean by interest coverage ratio? It is the operating profit divided by the interest expenses. Okay, a number of times you can cover your interest. That is what it is telling. 3.8 times you can only cover. Higher the better it is. Higher the better it is. So based on which the rating companies will decide what is the rating of the company. Then go to the handout and can you search for 3.8? Where is 3.8? Which range? So I got some chart here.
A minus.
A minus. Deepesh is saying it is A minus, it is right. Because 3 to 4.25 is A minus. Okay. So what I do is the rating based on IC ratio is A minus. What is the real rating of the company? It is AA. Getting it? Are you getting it? How we got AA? Because the company's real rating is AA when we were doing this analysis. Clear? So if you really ask me, if you want to take a call on interest coverage ratio, which means if it is A minus, you have to go and rate it as AA, which means 3 notches above the real rating of the company. In other words,
Sir, sorry to interrupt. How this we got? I just cannot follow you.
A minus.
Double A. A minus. I understand, sir. Double A.
Double A is given here only. Let me.
Okay, it is written.
Yes.
I think calculation is so. No. Okay,
No.
yes.
Senior debt is rated as AA.
Yes.
It is given here. Okay. So obviously there is a change between interest coverage ratio. Supposing if you consider only interest coverage ratio, it is A minus. Okay, but rating agencies will argue that we do not take only the interest coverage ratio as a base. We'll take a couple of financial other ratios also. And also we take into consideration of the qualitative factors also. How the performance of the company quantitatively and qualitatively. Qualitatively in the sense that how the board composition is. What is the agency problem associated with that board and the management? Management and the shareholders. There are various other factors they take into consideration and they come out with a rating of the company. Whatever it has been said and done, okay, academic research says that your rating of the company broadly revolves around one particular prominent ratio, which is called as interest coverage ratio. That is the reason we computed interest coverage ratio. It is easy to compute and it is quite practical also. That is what most of the academicians argued. And that is how we actually set a ratio called as interest coverage ratio as the ratio for computing the the rating of the company. Okay, so rating also we have computed. So let us go further. Okay, so all the other information is given here. Now, what are we supposed to compute here is, okay, so let us skip all of this. We can come to this dollar debt ratio, how to compute. Okay, so dollar debt ratio, how to compute it is market total value of the firm, you know it, how to compute. We just now computed. Multiplied by the debt ratio if you do it. Obviously, you get how much is the dollar debt. Simple it is. Supposing that there are 20% debt ratio, then what should I do is value of the firm multiplied by 20% if I do, I get altogether a different answer. Supposing that for 90% if I have to do, how to do it? Just do multiply 90% with market value of the firm, you get the debt level for the 90% debt. It is as simple as that. Okay, so now let us do the same for cost of debt and debt ratios. Copy this and go to Excel. Now what I do is I'll just copy these components, debt ratio, debt, interest expense, interest coverage ratio. Copy this and paste it here. We are not doing anything intellectual here. Bonds rating, pre-tax cost of debt, tax rate, post-tax cost of debt. Done everybody until this? So debt ratio as usual it is 10 to 90%, 0 to 90%. So what we have to do is we have to fill up all these blanks now, one by one. Why are we doing this? Because we have computed just now the cost of equity at various debt ratios. So we are now computing the cost of debt at various debt ratios now. And then what we do is we compute the WACC at various debt ratios. So ultimately we can say whichever the ratio, whichever the WACC is least at whichever the debt ratio, we are going to consider that as optimal capital structure. Is it fine? Now, so how much is the debt now? Tell me at 0% debt, how much is the debt?
Zero.
Zero.
Zero it is. So how much is the debt at 10% level?
40789.
How to compute that? It is 10% multiplied by what? The value of the firm? This one? Fix it. Are you getting now? So 10%, this is variable. Keep it 10% variable because the moment to double click, automatically Excel calculates the rest of the figures. Okay, so C25 is what your value of the firm is, right? So at 90% level, the debt should be 36,710 million it is, and rest is equity. Likewise it is. Clear? Done everybody until this? Okay, so tell me now, how at 0% debt level, how much is interest expense?
0.
So 0 it is. So how much is the interest expense at 4,710% debt level?
Multiply by cost
Debt
tax.
into interest.
Cost tax cost.
Wait. They given in the problem. They gave in the problem a 10% level of debt. Okay, so your interest expenses will be how much? 453. 453. Okay, so nothing else we know now as of now. We will not be able to compute with this information all these ratios here. Correct? You tell me how much is the pre-tax cost of debt. I can compute on this particular debt and I can tell you how much is the interest expense. Correct? Otherwise, you tell me how much is your interest expense. I'll tell you how much is your pre-tax cost of debt.
You can do by
But
pro rata.
we don't have none of the information other than this.
Can we do by pro rata? Here we can calculate the interest rate and we know the interest expense and we know the debt also.
So what we are trying to do is, one hint is given in the case that bond ratings are given. Bond ratings are given, and for them, how much is the pre-tax cost of debt is also given to us. Okay, so we know how much is the coverage ratio here. How much is the coverage ratio here? Tell me.
3.8.
Yes. So we know that interest coverage ratio here is AAA, and it is AA. And as and when we borrow more debt into the capital structure, what happens is debt rating keeps on reducing. Correct? Do you agree with me? Because the risk level of the company goes up, and because of which the ratings should fall to reflect that particular riskiness of the company. Clear? So now, can you tell me how much, interest coverage ratio, I just have to write here, right? So tell me how much is pre-tax cost of debt here now? For AA, AAA it is 5.2. How are we getting this? It is given here in this particular table. It has been, from where we get this particular table, it has been accessed by me in the Bloomberg. Okay, if you have got access to Bloomberg, this particular table can be accessed. How it is been computed? Bloomberg computes it and everybody else will take this particular reference as a reference point. How to read this particular table? For a AAA rating, 0.2% is the spread. What is the spread? What do you mean by the spread? How to read this table is, spread is for a AAA rated security,
5 plus.
you have to
5
add
plus.
risk-free rate plus 0.2%. That is how we got 5.2%. Is it clear what is spread? For example, D is 10%. Interest rate on debt is 15%. How we got this 15% is, you know that risk-free rate on T bond is 5%. So 5 plus 10 is 15%. For all these spreads, if you add 5%, you will get this particular last column. Is it fine? As and when your rating falls, your interest rate on the debt also increases. Why interest rate on debt should increase?
The one who is investing would seek more money.
Yes,
To invest in a risky
a
company.
commonsensical thing it is, because there is a risky level which is actually increasing in your company. So that is the reason every quantum of risk it has been increased. They're asking for more return. That's it. Clear with this? Okay. So now I'm expecting that this particular bond rating will collapses. Okay. So the next rating is what it is, A minus. Next is triple B.
A plus, where is A plus?
Okay. After A, it is A plus, right? So I'm just writing the ratings here. So triple B, next is double B, B plus, B, B minus. So apparently it may not happen this way. It can happen double A minus B, like that also it can happen. There is no guarantee that it is going to fall serially like this. Since we have incrementally increased this, okay, so this is the option we have got it. We are actually increasing, we are actually decreasing the rating by 1 notch. Okay, so now what I'm doing is whatever it is applicable for double A, I'll be writing here. What has been applicable for triple B, I'll be writing here. What is applicable for B minus, I'll be writing here by looking at the table. Okay, so it is 5.5, 5.8 it is. Somebody can dictate me.
6. No, it's 5.8.
After this?
5.8.
Yeah, next.
6.
6.25. 6.25.
6.5.
6.5.
7.
7.
7.25. Sorry, 7.5.
7.5.
8.25.
8.25.
9.25.
9.25. So what is the tax rate? It is 35% given in the problem. Okay. So we need not to compute these two. Okay, if you want, you can compute. So debt is this multiplied by 5.8 and so on. So interest coverage ratio is what? Interest coverage ratio is 1720 is your EBIT divided by interest expense. So ideally I should be writing infinity here, right?
Sir, please show this formula again. 453, 473, this one. No, second.
1720 constant because that is your EBIT divided by interest. Clear?
This coverage ratio.
And this is infinity because anything divided by 0 gives you infinity, right?
Sir, can you show how did you get 473, sir?
Yes, yes.
This one how we got? This debt multiplied by 5.8.
Why pre-tax? Post-tax?
Post-tax means tax has not been deducted still, right? Think, Naresh sir.
Okay, this is EBIT.
So can you tell me now what is post-tax cost of debt? 5.2 multiplied by 1 minus 35%, right? Done? Agreed? Are you getting the same answer as mine? How many of you getting? Just put it in the chat box as yes. Sharath sir, Sachin sir, Dinesh, Preeti. Preeti, madam, yes, tell me.
No, sir, I got the same number.
Okay, fine. The moment you raised, I thought you got a question.
No, actually, I'm just following what you are doing, but to understand properly, I'll have to go through it in detail.
Correct.
So the formula again, this 3.64,
this one
divided by.
What is this 17, 20? Interest coverage ratio.
Yes.
Interest coverage ratio.
Yes, so the formula.
3.8. What is this 1720?
What is interest coverage ratio is equal to EBIT divided by interest.
Okay.
EBIT is fixed now, that will not change.
Okay.
It's because you change your debt proportion, that does not mean that your EBIT will change. You are only changing the mix of debt and equity, right? So 1720, what is given in the problem? We kept it constant 1720 divided by interest expense. Interest expense is changing year after year. Is it clear?
Reduces, okay.
Is it
So
clear?
at 90% debt ratio, the interest coverage ratio is reduced. At 100%, it will be 0.
Yeah. Correct.
Got it.
So your post-tax cost of debt is also increasing as and when your debt is actually increasing. It is becoming risky, right? So now can we go to the last piece of the problem, and the crux remains the same, that the crux of the problem is compute the cost of capital. Let us compute the cost of capital, not the firm value, cost of capital. So cost of capital for computing cost of capital, what is required? Debt ratio is required. What else is required? Cost of equity is required. Cost of debt post-tax. And ultimately, what you get is WACC. Correct? Agreed? Any doubts?
No.
So what I do is I'll just copy this debt ratios and paste it here. So cost of equity already we computed, right? So what I do is I'll just go to cost of equity at various debt levels. I'll pick up this and I paste it here. Don't paste it as Control Alt V values. Correct? Cost of debt at various debt levels we already computed just now. I copy this, paste it as Control Alt V values. So can you compute WACC now?
So from where did we get these two columns? Cost of equity and cost of debt?
No, we just now computed.
Okay. So you just click on cost of equity once.
It is not visible, madam. Because cost of equity is here, you can see. This column, I am saying.
Okay, that is what I was. Okay, fine.
This one is cost of debt is this one. Just now, the table above.
Okay.
So WACC, can you compute now quickly? Cost of equity multiplied by weight of equity, 1 minus debt ratio. Agreed? Plus cost of debt multiplied by debt ratio. Agreed? See this ones.
Please repeat again.
No, WACC, how you will compute, tell me.
Cost of equity multiply weight of equity plus cost of debt multiply weight of debt.
That is what I am doing.
Okay.
Is it clear?
Yes.
Double click on it. Okay, Sachin sir has done it. Why have we done this? Minimum WACC is at 60%. That is what Dinesh sir is saying. Can you tell me which is least among them? This 8.502. I'm highlighting with this.
Yes, at 60%.
At 60%, which means borrowing should actually go and borrow 60% debt and it should never cross that. This is the optimal debt ratio for the company, which means 60% debt and 40% equity would be ideal for this. Understood, everybody? Why have you done this much?
Yes.
Okay, great. So this is actually very extensive work we have done it. Okay, so normally for PGP sessions, we take 2 to 3 sessions because many students won't understand what we are doing. So surprisingly, in your session, it's only 10-15 students, participants are actually doing it, and they're quite serious in what is happening in the class. Maybe that is the reason we could actually complete this just in 1 hour's time. Okay, so what I request you to do is go back and see once again